Welcome to the Retirement Protection Solutions Financial Planning Masterclass mini-series. Today's mini-series video is designed to be short and sweet, and we're going to focus directly on how we create the dividend stock portfolio as well as the individual growth stock portfolio. All right. First, a quick disclosure. You can pause your video to watch this or read through it. All right, quick introduction. My name is Larry Spoth. I am president and founder of Retirement Protection Solutions. I am an investment advisor representative. And of course, we are bound by those fiduciary rules. So we have to act in your best interest. Jacob Child is managing partner, investment advisor representative, and also bound by those fiduciary rules that we're so fond of. We are local to the District of Columbia, Maryland, and Virginia, so we're local. Our home office is right here in Tyson's Corner, which is where I'm at today. We focus as a firm on full retirement planning, which means we build full legitimate retirement plans for our clients. Those plans are inclusive of tax tables, current tax tables, inflation projections, required minimum distributions for when you turn 73. All of these things have to be in your retirement plan. We'll add all your other data inputs. For example, what is your Social Security income? If you're married, your spouse's Social Security. Maybe you were military or government and you have a pension, we'll add that into the plan. Maybe you have disability income, that goes into the plan. Everything goes into the retirement plan. Once we're in that plan, we want to build it out to reach your after-tax income goals. How much money per month after tax do you need in retirement? So we have all these different investment structures that we can use to potentially get you there. And then we'll test it. But it's got to be a comprehensive plan, and it is quite a process to work through with each individual person to build it out accurately. Today's focus is a short video, and we're only going to look at the stock growth portfolios at Market Guard as potentially part of your plan. All right, so in the master class, we went over safety, we went over structured notes. Right now on this mini series, we're going to go over growth and dividends. So how do we think about investing when we're looking for either a growth portfolio or a growth and dividend portfolio? Well, this is what most people do up here on this diagram, which I personally think, in my opinion, is not efficient. Most people are sitting in mutual funds, and for example, their 401k or TSP people are sitting in the different funds that are available. Or maybe they have an index fund or an ETF, exchange traded fund. Either way, let's say that you're sitting in mutual funds in your portfolio. Here's why, in my opinion, I think that's not very efficient. Because you could look into that bucket of stocks or bonds or whatever's in your mutual fund. If you could look into it, and you could identify that a particular amount of those stocks are trending down, trend, not volatility, but a trend down. And if you could look into that mutual fund and see all the stocks that are chopping sideways and doing nothing for you, but you could also look into that bucket and see the upward trending stocks that are in there, that'd be great. And it'd be even better if you could call the mutual fund company or your 401k, for example, and say, hey guys, it's me. Would you mind taking all the stocks in that fund that are trending down out and take all the stocks that are chopping sideways out? Just get them out of there. I don't like them. And just leave me with the strongest of those stocks that are trending up. That would be great. Well, we all know you can't do that. You're stuck with the stocks trending down and the ones chopping sideways. Essentially, you bought these on purpose. I mean, not literally you, but the fund has these in there, so you bought them on purpose. Now, you can make money in a mutual fund, of course, or any other type of fund, but wouldn't it be great if you could get rid of these? So what we did at Market Guard was we created an algorithm that helps us accomplish this, as well as analysts at Market Guard to confirm data, etc. But the algorithm, which is a rules-based process, we're going to only buy individual stocks for this portfolio because we want to micromanage what's in here. What we're trying to do, which is not perfect, nobody has a crystal ball, but what we are trying to accomplish is this. We want to stop buying the stocks trending down. We want to stop buying the stocks chopping sideways, and we only want to buy the stocks that are trending up and with a high dividend yield for income or to reinvest. Now, we'll do the same process with the growth portfolio because there's two. Somebody might be 3, 5, 8, 10 years away from retirement. They don't care about dividends, so they just want growth. So we'll have the algorithm. It's going to actually scan the Russell 1000. The algorithm will scan 1,000 stocks. It'll look at 27 different data points. It will rebalance the portfolio quarterly based on what the algorithm tells us as far as trend and strength is concerned. And those are the stocks that we want to buy. And it'll also identify the stocks that we don't want to buy. So we're going to try to stop doing this. But keep in mind, we're in the market, we own stocks, we still have volatility, we still have risk of loss, of course. But we want to at least go at it selecting the strongest of the batch, if you will. Okay, and we can do that for dividends or growth. Let's talk about dividends for a minute because they're so important to many people. Let's review what dividends are. Dividends is what I call, in my words, free cash flow. Okay, so think of it like this. I'll do a hypothetical. Let's say this company, XYZ company, is paying out a dividend every quarter. Because that company has a big balance sheet and it's got great revenues, that company is saying to you, hey, you own part of our company via the shares that you bought or the stock that you hold in this company. And for owning part of the company, we're going to share our profits with you. We're going to share some of our business proceeds with you. So this company, XYZ, essentially, think of it like this, is going to send you a check every quarter. Some of them pay monthly, some of them annually. They're all different, but they're going to give you money without selling any of your shares. They're going to give you that money for owning shares in their company, okay? Some companies pay dividends, other companies do not. The stock can go up, it can go down, it can go sideways, of course, but it still pays out the dividend, okay? And I term the phrase free cash flow because that's how I think of it. I own the stock for a particular reason. It's because I want to collect the free cash flow. So the goal is to create income without touching the principal. Let's say you owned 1,000 shares of a company and it's paying you the dividend. Don't sell any of your shares to create income. Why would you do that? Just collect the free cash flow. Let's see what that looks like and why we use it. This is a great example here, and you may have seen this example in the masterclass video, but let's go over it again. Let's hypothetically say this is you in the year 2000, and we're going to look at the S&P 500 returns, or we call this sequence of returns and losses. And we're going to look at this time period of 2000 to 2019, and let's say this is you. You have 700,000 and you just retired, and you decided, well, out of that 700,000, I'm going to withdraw 5% or 35,000 a year. You take it monthly, of course, but 35,000 total for the year. So you retired, and just your luck, this is the dot-com recession. So just your luck, the market was down, and you still had to pay your mortgage and buy food, so you pulled out that 35,000. So it's kind of like you lost money twice. Once because the market went down, and once because you pulled money, okay? The following year, you're down to 594,000, and the market went down again, because that was a long recession, and you still had to pay the mortgage and buy food. So you pulled out another 35,000. Now you're down to 481,000. Market dropped again, and you had to pull money out for the same reasons. Now you're down to 334, and I would say maybe you're starting to panic a little bit. But most people that come in to my office say, but Larry, the market will come back. Well, yeah, we believe it will. But what's happening if you're not working anymore and contributing versus you retired and you're pulling money out? So in this case, the market went up 26% coming out of that recession. But out of that return, you still had to pull 35,000. So your 334 went up to 387. Maybe we would say it might recover. The following year, 8.9% return, but you had to pull 35,000 out. That's more than you got in that return. Now you're down to 386. There's your return, there's your withdrawal, et cetera, et cetera. Now you're down to 356. And there was another recession, the financial crisis, the mortgage debacle, everything that happened here. And you still had to pull money out. The market doesn't care that you're losing money and you're stuck paying your mortgage and that you have to buy food and clothing, et cetera. Doesn't care. So now it's mathematically correct. Following this sequence of returns, you're down to 202,000, a great return again, but you actually pulled out more than you earned. So this is what we call a classic spend down. This is how accounts are spent down. Now, history doesn't repeat, but we don't know what the markets are going to do in the next 1 year versus 5, 10, 15, or 20 years while you're in retirement. So we have to think about this type of scenario, because in this scenario, during this time period, if you were pulling out 35,000 and we didn't even adjust for inflation, this portfolio is out of money. It's gone, which means your income is gone. You suffered a classic spend down and eliminated your income. So how might we try to solve this problem? We'll go to this screen here. We would create, in this case, we would suggest to you, use a dividend portfolio. So at Market Guard, we have a very nice dividend portfolio. The stocks are selected via the algorithm, the rules-based algorithm that I mentioned. So what we would rather do is, if the market is down, don't withdraw or sell any shares of stock. Don't sell when the market's down to create income. But you're stuck because you retired and you need the income. So we're going to say hypothetically, because dividend yields vary every day, we'll say hypothetically the dividend yield on this portfolio is 5%. Remember, dividend yields go up and down every day. Sometimes companies even stop paying dividends. But in this example, you had 700,000. I didn't sell a single share, but I collected the free cash flow, the dividends. I took the dividends out of the portfolio without selling a single share of stock. So again, this year, the portfolio was down because the market was down. Can't help that. But these stocks still kicked out a nice dividend cash flow for me to live on. And then when the market came back, since I'm not selling any shares, my portfolio would be able to enjoy the growth back up because I never had to sell any shares. I just collected the dividend cash flow. Same thing here in this recession. I didn't touch my shares. I just collected the dividends. So the goal is, let your portfolio grow. It can move up or down with the market. Hopefully we're getting growth. We're just going to collect the dividend cash flow. But there's one problem. The S&P 500 that I used in this example, it doesn't kick off a dividend yield of what, in my opinion, of any significance. The S&P is probably kicking off about 1.3% dividend yield, plus or minus. So we can't really do that because it's not enough for us to use for income. So we'll use the Market Guard portfolio that I showed you with that diagram, where we're selecting dividend paying stocks, utilizing that algorithm to help us select trending stocks versus, I don't want to buy the losers. I want to buy the ones that are trending with dividend yield. Obviously there's volatility, but that's what we want to do. We'll use the Market Guard dividend portfolio to help create income for retirement, if that's appropriate for your case. So I told you this would be a short video. So let's talk about step 1, 2, and 3. Step 1, you have an investment. Maybe it's a 401k, maybe it's a brokerage account, whatever the case may be. We will provide you a complimentary Morningstar analysis based on your current investments. What is a Morningstar analysis? Morningstar is a gigantic financial firm. One of the things they do is analysis. So sometimes you might decide, I want to buy a certain product, and you'd look for the Morningstar rating. So we'll send your statement up to Morningstar to get a third-party opinion of what's going on inside your portfolio. We want to know so that we can maybe improve your position there, we will have to see, but we want to get that analysis and it's yours to keep. It's also going to show you what are the hidden or internal costs of things that you hold, like mutual funds. Step number 2, we want to understand your goals and objectives, because ultimately we want to build your retirement plan that includes inflation projections, tax tables, required minimum distributions, and we'll test it with random market events to see if it holds up, to see if your income is sustainable in retirement. And step 3, when we've built out that plan, we're going to drill down into it with you to make sure it's the way you want it, based on your goals and based on your risk profile. Fiduciary responsibilities, right? We've got to diversify you based on your goals, not what we think would be good. Okay. We will make recommendations, of course, but we want it to be able to meet your goals. So we'll stress test that retirement plan. It's yours to keep. It's complimentary as long as you have investable assets of over 500,000. Do we ever make exceptions for that rule? Yes, we do sometimes if it makes sense. What we're trying to do is have enough money to diversify into these different products to meet your retirement goals. And if we can do that for you, the planning process is complimentary. Thank you for viewing the video. Thank you for allowing us to introduce the Market Guard portfolios. Have a great day and have a great retirement.